You can retire on Social Security. Chapter 2, Average Index Monthly Earnings, the AIME. The most important part of your benefit is your AIME, your Average Index Monthly Earnings. But before we go on, let me highly suggest you look at your earnings history that the Social Security provides to you, like the sample statement from the previous chapter. Oops, missed a period there. Does it look correct? Is the Social Security Administration missing something? You've got to make sure this information is spot on because everything is based on this. I had one guy on my YouTube channel say the SSA missed a couple of years and we had to fix and increase his benefit by $20 a month. $20 a month? That's nothing, you might be thinking. But when you figure out how Social Security works with the cost of living adjustments and survivor benefits for a spouse, that $20 can really make a difference over time. Thousands of dollars, in fact. Okay, so assuming our benefit statement is correct, here's what we do. We open a blank spreadsheet with 4 columns labeled year, taxable wages, index factor, and adjusted wages, like this example below. And here's the example below, right there. So year, taxable wages, index factor, indexed earnings, all right? Let's keep going here. Where do we go? I call it adjusted wages. Got to fix that. Index earnings. Did I call it? Yeah, I got to fix that. So that index. That's why you read the stuff out loud, my friends. Can you see a couple of issues there? So taxable wages, index wages, and adjusted wages. So we will fix that. Like the example below. Find your indexing factor by going here and enter the year in which you turn 62. Multiply the value in the taxable wages column by the value in the index factor and put that amount in the index earnings column. So what you'll see here is you got taxable wages times the index factor. It gives us our adjusted wages or indexed earnings. And that's table 2. Okay, so now you have a spreadsheet with your entire work history. There may be some years we have a 0 for your wages. That is fine. You must keep those zeros in the spreadsheet. I cannot emphasize this enough. Don't change anything from what the SSA reports. In the table 2 above, notice I have some numbers in red. That is because to get your actual Social Security benefit, you only use the top 35 years of your indexed earnings. That means you need to go line by line to identify your top 35 years. The amounts in red will not be used to calculate your benefit. And if you're doing it on your own spreadsheet, you change the numbers or the color coordination however if you want. I'll show you as we go forward in this book about the numbers in red and how they get, we don't use those and use other numbers instead. Now add those top 35 years of indexed earnings. This is called your total indexed earnings. So again, you're adding your top 35 years of indexed earnings, all right? And we'll show you a table here. If you made the median U.S. earnings every year over your work history, your total index earnings will be around $1.692 million. If you made the maximum taxable Social Security wage, your total would be $3.753 million. Take your total indexed earnings and divide by 420. This is your average index monthly earnings. For instance, if you made another typo. So this is why you read this stuff out loud, man. I'm still putting this up online because I'll fix these typos and you'll get the better book. But it's still good for you to see it. And it's good for me to do this as well. So, for instance, if you made the median wage, you would divide that 1.692 by 420 and get $4,028. If you made the Social Security maximum, your aim would be $9,300. Folks, this is the most important number when it comes to your Social Security benefit. You've got to understand how this works. And you've got to make sure it's correct. Here's a video I did in 2018 which describes the process, and here's the updated one I did for 2019. Now that we have your average index monthly earnings, we must move on to calculate your primary insurance amount, your PIA, which is what your actual benefit will be at your full retirement age. Woo, it's confusing. Please remember, everything is derived from your AIME. Logically, then, we need to make sure the numbers used to calculate your AIME are correct. And that starts with you looking at your Social Security earnings history to make sure there are no significant gaps or omissions. A couple things to consider about your earnings history with Social Security. There are wage caps for how your benefit is determined. In 2019, that cap was $132,900. So if you made $150,000 in 2019, your benefit record will only reflect the $132,900 because that is a limit for the amount on which you pay tax, the Social Security tax. However, say you are in real estate and had a smoking hot year in 2006. You look at your earnings record and it reflects only $24,000 in taxable earnings that year. But you know you made much more than that. You need to contact this SSA to make a correction. Self-employed, don't make this mistake. And this leads me to my final point of this chapter, the propensity of self-employed individuals to take a dividend instead of a salary in order to avoid paying FICA. I can't begin to tell you how many small business owners I've worked with in the past who will move mountains in order to not have to pay FICA tax on their earnings. Let me give you an example. You're self-employed running an auto detail shop. No employees, just you. Your gross income is $100,000. If you take this as a salary, you'll have to pay 12.4% in OASDI and another 2.9% in HI for a total FICA tax of 15.3%. You don't want to lose $15,300 in FICA taxes on that $100,000. So instead, you pay yourself a minimum amount, say $24,000 as a salary, and the rest as a dividend, which is not subject to FICA. Fast forward until you turn 62 and start thinking of retiring. Your Social Security benefit will be incredibly low. Why? Because you're only paying tax on $24,000. Hopefully you saved and invested some of that dividend money because your Social Security income is going to be a pittance. Why not just pay the FICA on the entirety of your income so you know there will be a bigger benefit awaiting for you when you retire? Secondly, and trust me on this, the IRS knows of these scenarios with self-employed individuals too. If ever there were a red flag, if ever there were a red flag to lead to an audit, this would be it. Moral of the story, don't be penny wise and pound foolish. Just pay the tax and recognize you'll get it back at retirement when you need it most. All right, so that's the end of chapter 2. We'll keep going, but I'm doing this to put it out there, get you to see how the book is. These typos, small stuff, but they will be eliminated as we go forward. I think I got that. Okay. And we're gonna eliminate all that stuff. So don't say, oh, but you have typos. I acknowledge that, but it's just small stuff, and we're gonna eliminate all those. So this is chapter 2. Hang on with chapter 3 coming up next. All right, don't forget to subscribe and smash. We'll see you next time.